Brennan, thank you so much for joining me today.
Thanks for having me.
Let's start with the lightning bolt moment of Infinity Constellation. So, what did you see in the world? What problem did you see in the world that convinced you to launch the company?
Well, I think that it's sort of like it came from a couple different angles, which I think is pretty interesting. So, Francis Pedraza is the founder and chairman of Invisible, which is one of the world's largest AI data training companies. I was actually their first enterprise customer many years ago. And then he sort of was starting to encounter the innovator's dilemma at Invisible because it had gotten so big, but he saw all these like blue ocean AI service companies that could be started like Invisible that they weren't able to all get after, right? Because like a big company has to stay really focused on what they do, and what they do is, some of the best AI training in the game. And basically at the same time, I had just built an insurance company called Butter that I had sold, and I was looking at building AI to automate a lot of like humans out of financial services, because all the biggest problems that I found in financial services through my whole career was because we hired loads and loads of people. So I generally believe that you can increase GDP and increase better products by having like more efficient humans in the process, right? And so I had sort of like looked at this being like, wow, I really want to build some AI service companies. And Francis was like, I want to find a way to do this. And so we really got together and created Infinity Constellation as a holdco for applied AI companies delivering full stack services. And what we found out from both our journeys was that if you think of like a lot of SaaS companies, they're trying to make you be a better baker. So they're like, here's a mixer to make you make a better cake. Go make that cake. We're like, don't worry about being a baker. Here's a cake. And I think that works really well in AI because a lot of people want to use AI, but these models are improving really rapidly. So it's like a new innovation every month. And so even people that are in the business, it's really hard to stay on top of like what's the best tool for the best thing, how do you build the best workflow. And so I usually have people anecdotally throw out to me, oh well, like AI hallucinates, or like Sam Altman says AI always hallucinates. And I'm like, yeah, but like your employees always get things wrong too. You don't just stop like hiring people because of that. And like this tech is very impactful, and like literally month over month it's getting better and better and better, and people are investing trillions in making it better. So like why would you not use it in services? And so all that sort of like culminated with Francis and I creating Infinity Constellation to really just build like a $1 trillion holdco that supports AI service companies. And so we have companies like Radiance, which is an AI brand design agency. And yeah, we use a lot of AI, and the founder, Jacqueline's incredible. But we have really great designers. And end of the day, as a customer, you just want really good brand design. Or we have like Zero Hiring, which is our AI RPO. So it's a high velocity recruiting as a service. And they basically, in the industry, it normally takes 75 days to find and place a candidate at high volume. They do it in 22 because they're using AI workflows. But end of the day, we're very like outcome focused with all of our customers across all of our products. So like we have 8 other companies like that. And we've gone 0 to above 7 million in under 12 months of revenue. And so we're very highly efficient. We're growing really fast. And so I think that's like really, we're now at a point where we've proven our Holdco model is really working for AI services. So that's why that's a bit of the story of what we've built and what we're up to.
Wonderful. That's a great introduction. So going outside the company for a second, and just the mechanics of running a holdco. So if you go from a fintech or a SaaS company to a holding company, it's just a very different mechanic. So maybe
Definitely.
Can you compare and contrast running a company, like a software company, versus running a holdco? Like what mental models did you have to update to run this company?
I mean, I think the first is like some of your instincts are wrong as a founder. So as like a software founder, I'm in like founder mode. I'm in the weeds. There's a problem. I want to fix it. I want to get the data. As a Holdco CEO, you have to be a lot more like, the GOAT Charlie Munger. And you actually like, a lot of people are running Holdcos these days and they try to like get in the weeds with their businesses. You actually need to like abstract yourself from that, and really like you can make investment, you can de-invest, you can back CEOs, you can change the teams. But at the end of the day, you have to really like be more of a, like I try to have Infinity be more almost like a Citadel for AI services, or like a data quant hedge fund, where like we should have really good data on underwriting companies, really good data on like quantitatively how we think these companies are performing. And then that helps us allocate and helps us manage our portfolio. And that you have to be like somewhat abstracted. So in a lot of cases, like I'm playing more of a board member these days with our 8 companies. I'm not in like, knocking on doors, closing sales, building out products, doing stuff that I like really am great at as a founder. And that's quite hard because if I pop too much into founder mode, I kind of become shadow CEO of a company, and then that disempowers the founder who's usually better at their job. And so the thing that like keeps me up at night is that most investors' advice is wrong for founders. And now that I'm like a Holdco CEO and not, a SaaS founder or a fintech founder, I have to recognize that I fall more into like the investor Holdco camp, and they know more than me. And I'm actually here to more identify risks and be a great support and make allocation decisions. And so that's really like the different mindset. And like, Francis and I are still like super involved in all the companies, but we're definitely involved in like different ways. Like we're pushing on like the risks of the business and is it positioned correctly? And most of our businesses that are like really ripping, they're positioned perfectly. So like, how are they counter positioned against legacy services industries in the market? And so we spend a lot of time really making sure we've nailed like the vision and strategy and that we have the right players in seats. Which is like, I think as a founder, you do some of that, but you also are a lot more tactical around, like just shoveling the dirt, which is like a very, very important job. And like getting that granular data on how to pivot and iterate your product. And my product now is Infinity Constellation. So I'm iterating a lot of like, well, who are the right founders to attract? What are the right businesses to back? How fast should we go? When do we do a double down? Those are all like my iterations. Whereas like, running a fintech's a little different. So
now going into this analogy of you're running an AI native Berkshire Hathaway that builds like YC. So going into the weeds of operations a little bit, you raised 17 million, launched 8 AI service startups on day one. Can you walk us through how take an example, and do you incubate these companies, or do you find founders who are already working and then you kind of acquire them like Berkshire does? Kind of how does a company get formed here?
It's very much like Inception. So we have a blueprint, which like Invisible is Palantir for operations. And that's why it does AI training and applied AI at the Fortune 500. And we basically looked at that blueprint that mixes humans plus the technology and how that wins. And then we say, oh, wow, like we'd really love to do something in the EA business because, we think there's a lot of alpha to be made in EAs. So then we find like an awesome founder like Jen Samarco to run Everest. And she really comes up with the positioning, runs the company, is the CEO. We're more like junior co-founders to her in that. Or we have like Stuart Lacey, who's a repeat founder. And he really came up with the idea of Labyrinth, which is RegTech acceleration. So we do that for prop tech and actually like nuclear power and energy, where we help get approvals faster using AI. And so he really drove that, but like we showed him our blueprint and then we co-crafted a memo together around how we see the positioning, what power he's using from like the 7 powers is one of our business Bibles. And then we spend a lot of time thinking about the business frameworks that we do. And then we share learnings of other companies, but it's very much like the founders driving it. So we're building these businesses from scratch. We are like qualifying the people we're working with, but they're deciding if they want to be in the trenches building with us, and we're deciding if we want to build with them, right? So it's very much like, Inception.
This looks similar to Venture Studio, but I'm assuming there are a couple of differences. So can you just talk about compare and contrast to a Venture Studio model?
Yeah, I think it comes down to incentives. So like a venture studio and I are both creating businesses, but the end customer of a venture studio, I believe, is the venture fund that's investing in the idea. So like if I was an MD of a venture studio, I'm trying to create a bunch of ideas that are really fundable that then can go return a good MOIC for my fund. And then I can raise fund 2 and keep doing it. Right. So like their ultimate goal is to like create companies that are attractive, lucrative investments and liquidate funds to their shareholder base, which they're LPs. For me, as a Holdco, my shareholders have backed us to create companies, but a Holdco exists forever. So like we're a Delaware C. I don't have a 7-year time horizon. I don't have to liquidate all my assets. So if I create 10 businesses and 2 are breakout businesses, my incentive is not to market them to a seed stage fund and make really investable companies. My incentive is to make really, really, really investable businesses in the long term. So like that means the businesses have super good, predictable cash flow and they're real businesses driving real EV. And that little nuance of like, I don't necessarily need to jump a hype machine to build a business. I need to build a really good AI full stack business within my thesis. And so and then when that business like goes big, I'm on the same side of like the founders and the late stage investors because I'm going to own part of that business indefinitely. And that's I think a key incentive change and why we actually looked at doing a venture studio model. And ultimately, like we decided because we don't need large amount of capital to start a lot of these AI service businesses. So like we really want to have long-term ownership in this and have like a really long-term growth horizon. And so we don't want to just be like capped at a 7-year fund cycle. Does that make sense?
Yeah. And the companies that you start, obviously you get a CEO, you get a team, they get equity. Obviously, you have equity in the company. Then the people who have backed you, Infinity Constellation, can you just talk about how the portfolio CEO, you and your backers, like how are the incentives aligned? Because I'm sure your backers have time horizons, even though you don't. So how do you think about that?
Yeah. So how we get liquidity, I heard how we get liquidity for our investors and then how our founders are aligned to that. So the step one is like, we are backed by funds, family offices, big and small. And, you know, at the first, our goal is like any other venture backed company where it's like, we want to go IPO or we want to do secondaries for our investors when they like need to get liquidity. So like, that's pretty basic. It's like drive EV. And I think driving EV is like how predictable and sticky my cash flow is. So if I build really good service businesses that have low churn, high margin, that are good growth, that creates very predictable cash flows. And then based off of that, I'm going to be able to like return money for shareholders. So that's how we stay like aligned at a macro level, very tactically how incentives work. And I don't want to talk like numbers, but I'll be like kind of vague here. All of our founders have shares in Infinity as a holdco, but they also have shares in their existing business. And that creates like a good dual incentive where they're willing to help all the other companies, but they're also willing to like, they have a nice little hedge to build with us and to like build in the right way. And ultimately, like, let's say you're a business that is a single or double. Like you set out as a founder to be a home run, but let's say you're a single or double. If you're a profitable business, which all our businesses are unit economic profitable and you're making money, we'll happily keep you in the holdco indefinitely. And so as a founder, that could be a great asset for you and your family and for the business versus like, and so you're aligned with us, aligned with your shareholders. On the other end, if you hit a home run, we actually get to control the time that you get to come out and do your Series B. So like, we'll happily launch you out of the holdco. We'll co-lead your future rounds. And that's aligned with my shareholders because that's creating value for them. That's aligned with the founder. And that actually de-risks the Series B, which is like one of the hardest rounds in venture right now to go and get because you can really time it right. You can have the right milestones. You can build your business in the right way. And that's the big message, I think, around like what we're doing at Infinity is like incentives matter. And how we've lined up our incentives with our team and with our shareholder base is like really strong. And like, you know, I definitely have like done some of this, but Francis is like the brainchild here. He like lives and breathes governance all day and structure. And he like just sits here and thinks on this stuff. And he's been talking about it with me for years since I was like a first customer of Invisible. And so that like we've really built in the right flywheels to keep everyone aligned. And that's like a Munger thing, right? Like if you focus on incentive alignment, then you do a lot less management.
Yeah. I think it's giving the portfolio founders a stake in the parent company, the holding company. That's a very interesting angle and rare, and also it aligns them long term, and that's a very interesting move. So in addition to obviously they're running the portfolio company, though they have a good stake in that, but it's a very interesting angle. And also I think when you talk about incentives, reminds me of obviously Charlie Munger has talked a lot about this, Warren Buffett, but also Renaissance Technology, Rentech, the hedge fund, obviously the most famous well-doing hedge fund. I was listening to a podcast episode where they put a lot of thought into figuring out what incentive mechanics will help us retain the best people. And many people are tenured, like they stay there for like a couple of decades, if longer,
Yeah,
the average tenure. And because of the reason is that the incentive is so structured, it's well aligned. The longer you stay, the more you make, and also you have a stake in the company. You have it's very net. I think incentives matter a lot, and I think you made
totally.
a very good point.
Yeah. I mean, my favorite of this is Citadel. Like, I think they've
there we
nailed
go.
it. And like really, when Francis and I were creating Infinity, we were like, and there's like a slide in our deck somewhere. But like, it's like the Citadel for AI services. And it's really in our head. We're like, who are the best founders by category? Just like who's the best portfolio manager in equity or portfolio, like in debt, right? And let's bring them in. Let's have them create with us, but then let's give them like so much equity and then our infrastructure is so good. It's like, why would I ever go and like do this outside of here? Because this is making me so much money and so great. And so that's like really like what we're trying. We took a lot of inspiration from that, and I think like the more time I've spent digging into like Citadel and digging into like these like quant hedge funds, like I think there's an opportunity in venture and in company creation to be a lot more data driven and a lot more like quant hedge fundy about it in like very positive ways that I don't think we've been as data driven as we could have in the last like 20 or so years. I know I haven't. So now it's like kind of a thing that I'm very focused on, because I think if you can get the incentives right and then you can measure it with a lot of high fidelity data, which like AI and AI agents allow you to do now, because you don't need to like spend as much time manually getting data together, then you can, as an operator and a capital allocator, make a lot better decisions. And so anyway,
I'm a huge admirer of the founder of Citadel, Ken Griffin. And the more I've read about him, I've listened to his style, it's incredible how much thought he has put into company building, which is incredible. All right, going into the target market that you're pointing your energy towards. So professional services, massive market, multi-trillion dollars. Now, when you look at what sections or what areas to choose to build companies in, what characteristics of a given subvertical excite you? Like, what makes you go, okay, that is a good target market to attack?
You know, this answer changes a lot. When I first started out, I'd be like, okay, accounting, right? Or like it's things that I knew, and I was like, oh, this could be a thing. How it's actually shaken out is it's so much like our rate limiting factor is, and the reason why I do these podcasts is because I'm trying to find more founders and I'm trying to find more builders, because our rate limiting factor is awesome people to build with us. And so I actually usually let the awesome person that wants to come build with us pick a category, pick a market, and then we start a process of finding human-centric service businesses that haven't been really impacted by tech, and really go from there. And so what's so funny is there's someone I'm talking to right now that is pitching us pool cleaning rollups. And it's an IoT device with pool cleaning route. You could do a roll up around it. And then instead of using really skilled labor, you can use unskilled labor, because like the IoT device is handling, distributing all the chemicals. So it's really like route management. So it makes it a very easy roll up opportunity with lots of EBITDA. I never would have thought pool cleaning would have been something I would have entertained or thought there would be like EBITDA in there for us, but there is, right? And that's just because that person is an expert in IoT and an expert in pools, and that's been something that's like really, really interesting. So it goes back to sort of like Inception, but if you really look like from a macro standpoint on like how I underwrite it, I think until we have really big breakthroughs in robotics, stuff like plumbing and like propane and HVAC, electrical, like that's harder, right? And I think people are rolling up HVAC right now, but like a lot of those businesses are power law businesses where 20% of the market owns 80% of the market, or some degree. And I think until you have robots, you're not going to see a lot of like EBITDA margin pulled out of that. But businesses that like, I love design, because those are a lot of like people who work behind computer screens, or you know, like you look at a design agency, they trade at like 1 to 2x EBITDA because they're so customer centric. They're project based because their revenue's not really durable. So like you could go find someone awesome like Jacqueline, who's our CEO of Radiance, and then go and build a repeat revenue model where you can lock customers in, use AI to expand the margins, and then really compete both from an investment profile, but also from a customer quality profile. I like really like that, right? And so that's sort of been like the rinse and repeat of a lot of what we've done, is like what's being done behind a computer screen, what has cash flow, what's stuff that like you're using, I'm using. Like a lot of the times I'm like, okay, I'm creating a business. There's a new business I want to create in IT services. Why? Because we started having to hire a bunch of IT people because we're all around the world and we need laptops and we need all sorts of things. And then we're like, wow, this is like a cost center, but actually I bet this could be a really great service. And I bet AI could really help this service. So I started talking to IT administrators. And I was even talking to one that managed Madison Square Garden. And like, it's a very manual business, still not using a lot of tech, even though they're implementing technology. And I'm like, okay, that seems really right. And so that's like kind of how the discovery process works.
Now, on day one of building a company, the portfolio company, obviously the founder is in-house, everything is in-house. What metrics or what signals do you use to identify, okay, this company is ready to graduate out and be a standalone company? And maybe part B to this question is, you mentioned you would, for breakout companies, you would lead Series B.
Yep.
Where does the capital come from? Do you do SPVs, or where does the capital come from for those larger rounds?
So we're super new. So we're literally like a year old. So we're just walking on that road now with a couple of our breakout companies. And so the first is we always default to doing what's right for the founder and right for the business. So they drive that. So like if you're one of our top companies and you're like, look, I can really deploy 10 million and I want to go and like bring in a specific fund to do that, they can go do that. And then our board approves it, right? So like we always default to like what's right for the business. And that's like our golden rule that like Charlie Songhurst is on our board, and he's like one of our big investors and he's incredible. Shout out Charlie. Go raise an angel check from him if you can. He's great. But he was like, hey, we should always default to like do what's right for the business and then everything else will follow that. And that's something Francis and I have really stuck by. And so that's how we think about it for the business. And then for us, like when we co-lead it out, we basically raise at a very like favorable multiple, and we have like a really broad investor network. So like we don't necessarily have cash flow issues or access to capital issues, especially for our top performing companies. And so we'll either raise at Holdco to support that, or we'll like do an SPV to support that. One of the two. But I think we're still like in the wind a little bit as like what's better, because like to bring you in, since we're on a podcast, so it can't really be confidentially, but like I think it's like a good healthy debate that I'm fine having publicly, which is like you have some of your best companies, they really need to drive like when they want to take that external capital. And like from one end, I could make a really great argument that like never raising for them and owning as much as I can is really great. But on another argument, like if I'm thinking like a quant hedge fund person, I'm like, oh wow, I wouldn't mind, this is becoming a power law thing for me, I wouldn't mind risk sharing some of this and then basically starting more companies to even out the portfolio. And so I think that that's like a very like ongoing debate that we have as a board and as a team, and we have these like ongoing conversations with the founders as well.
That's great. And when you're early and you're building this out, and how do you address the too many toddlers in the house problem? Meaning, how do you allocate resources? Because I'm sure everyone wants the max resources. So how do you allocate resources, and what's the optimal number of simultaneous portfolio companies you can realistically help? Because in an ideal world, of course, you would want to have 1,000, but you can't help 1,000 all at once. So what's the optimal number? And then you're like, okay, we got to start graduating some of these out because now it's too many.
So every investor I bring on and every board member we invite to be part of the board, I say, I'm a dad that has 8 kids and I need lots of uncles and aunties to help me raise the 8 kids. And like me and the platform team of Infinity are a rate limiting factor, because like you're right, our model is great. The data is showing that it's working. So like, what's the rate limiting factor for us just like going to 100 companies, right? And I think the first is like great people that want to build with this. And then the second is like we manage a lot of back office for the company. So like finance, HR, legal, IT, that's benefits to the founders. So like we also need to like dog food and use AI and scale ourselves up to support more companies. And then we never want to drop underwriting standards. So like we want to make sure that we're holding that quality bar really high, but that we're also like iterating and positioning our current businesses appropriately to their max potential. And then how we handle internal resource allocation, most of our, again, this goes back to incentives. So like if you and I were to go raise a venture round, and let's say we raised 100 million or 5 million, doesn't matter. You burn that in 12 to 18 months every time. For our Holdco, it's a little different. So the founders come to us, and when they start the idea, they write an investment memo. In that investment memo, they set out what capital they need based on what milestones. My board pushes back on that or agrees. They approve it. And basically, as long as you have positive unit economics and the board continues to approve of the vision and the direction you're going, you get access to more capital. And that's how the business works today. And what's crazy is all our businesses have gotten to like really, really good venture milestones with very de minimis amounts of capital, because like they're not incentivized to go and take that 2 million or that 100 million and burn it in 12 to 18 months to get to the next cycle. They're incentivized to build product and sell and disrupt the service industry. So it's like a little bit of a different vibe. Like there's not it's not like a knife fight for capital. It's more of like who's earned the right to get to the next stage of capital. And like one of our key cultural pillars that we set as a group with the CEOs was that headcount kills. And so like we're all actively trying to hire like as few people as possible. Like for instance, I would like love like a one-person CEO. Like I was talking to someone out of MIT yesterday about an autonomous company and how to make a one-person CEO company. And I think it'll happen in our lifetime. So like most of our founders are competitive, and like they don't want to go and burn they don't want to go burn 5 million in 12 months and hire a ton of people like the businesses of 5 years ago. They want to go and build these like really efficient companies. And so it's just a bit of it, and like incentive differences that around the allocation. And then on the business side, it's like largely an underwriting and then rate limiting factors of like how many businesses we get when. But it's a lot.
Let's talk infrastructure. You mentioned earlier that you help with back office and accounting,
Yep.
HR, tax, which is good. Now, on the technology infrastructure, what resources are shared? Because it's AI. AI is a common thread. I'm sure the bunch of needs are overlapping. So can you talk about what technology infra is shared across all the companies?
So initially when we actually thought there'd be a centralized tech team. And it's funny, I've gotten this question like multiple times today, so it must just be the energy of today is asking about this. But we initially were like, oh, well, we'll build like AI agent infrastructure centrally, and then it'll fork, and then da-da-da-da-da. And then what happened is like, just like a venture portfolio, our portfolio started getting power law, where like one of our companies really started to break out. And then it became like, well, all the tech resources should just go to that company because that'll return this. And then we were like in our own innovator's dilemma at a Holdco, but my value as a Holdco is to create more businesses. So then I was like, okay, this needs to be solved. And so really what we've done is now we ring fence tech teams. Every tech team that gets started has a technical founder that's like an applied AI person. Every team has ring fenced engineering resources, just like a venture company. And so we want that because we want that IP siloed and investable. The second reason is that all the businesses, even though they're AI service businesses, are really different. And like Everest requires really different tech for its EAs than Radiance as a designer, than like Unlimited for like AI VC analysts, right? And so like even though they're all like AI agents or AI services, they're like actually quite different. And they're using different foundational models. They're using different workflows. So they're bespoke. Now, then if you pop back on your CEO Holdco hat, you're like, okay, I've just lost all my network effects between the tech, between all the companies, because now they're all siloed. So what our Adam Haney, shout out to him on my team, he was one of the early engineers at Invisible and is ex-Meta. He came up with the idea of creating like what we call code commons, which is any of the company's developers with permission from their board can post code to basically our own private open source library, to Infinity. And then as other teams adopt it and fork it and use it, they get shares of Infinity Holdco. So let's say you make a really good authentication app or an authentication workflow. You put that, because that's not necessarily strategic, everybody needs it, but it's really key. You can put that in code commons, and then everyone can fork it and prove it, and then you get shares. So our board approved basically a share bounty for all the engineers to like to basically like commit code and share code to each other. And so that way, like, you know, company A, company B, their investors are okay. And so like they have approved what goes open source in Infinity, but then we also are still getting like the network effect of sharing the technology. And then every 2 weeks, all our developers get together and basically like do demo with like the coolest stuff. And it's actually gotten like kind of competitive. Like today, they actually happened like, I think today. And
Right.
one of the CEOs told me, he's like, yeah, my developers came to me after this meeting, was like, how do I get more tickets in this week? Like, I want to ship these features by like the next 2 week sprint because I want to show them this. So it's like, I don't know, there's like healthy competition among the teams.
Now, because the way Holdco is structured, how does it influence your choices around model hosting or going full stack, vertical AI, or
Yeah.
building proprietary models, fine tuning, a bunch of these little considerations? Call it Infinity Playbook. How how does this influence your thinking, and do you kind of coach or train your founders to do things a certain way versus old school SaaS playbook where you just hire a whole bunch of people and put more more money towards it?
I mean, our playbook very much is like an orchestration playbook. So, like, our thesis is we control distribution, we deliver full stack products, and then we haven't built a foundational model yet. I think we would, and under the right circumstances with the right talent. It's just like really expensive, and I think they're going to get commoditized, right? And I think the ones that are really big are really big, and I'd rather be on like their side of the table as an orchestration partner that's leveraging a bunch of different models. Because let's say you're building, great example, you're building a full stack AI company for real estate. You might need a voice AI agent. You definitely need a PDF reader. You definitely need someone that's like a couple NAN flows, like connecting into like Yardi and a couple other systems. Like there's a bunch of stuff, and those might all be really different pieces of technology from different providers. And so like HeyGen might be the best video AI, and then there might be the model that's the best, like Mistral the other month was like an amazing benchmark for PDF extraction, and then like Google Gemini has come in and been like awesome on video rendering. And so I think it's up to the founder to pick the right model for their service stack. So for one, we play with everybody, and we're an orchestration and distribution stack. So that's the second. Now a founder could come and pitch me a foundational model, and I could be really interested in it. But I'm probably like not the one out there, like we're not the ones out there like funding and building that per se, because like I think that takes a lot of compute. I think that takes a lot of expertise. And like we would look at it, but we just haven't yet, right? And so I really like empower the founder, but I steer them towards like what's been working for us, which is like own the distribution, play with everybody, and iterate like crazy. And I think that that's like the right sauce.
What are the first three hires a portfolio company would make? No, I know it depends on the company and everything, but on average, what are the first three hires, and in what order?
I like putting them together as like a founding team or like a founding unit. But I think the first founding unit is like you need the business thinker. You need like the business system thinker / visionary / salesperson. That's usually the CEO. And then you need the person that's like the cracked AI workflow kind of person. And that's usually like the VP of engineering or the head of engineering of the team. And then I think depending on like the product or company, so like our company, Lightning, is a direct consumer philosophy app. So we like digitize a bunch of philosophy books, and then you can go on and get your own like philosophical DNA test. You should do it.
Right.
One of the founding partners of that is a Rhodes Scholar, Zohar, who's like an amazing philosopher, and he's a rabbi. And just shout out to Zohar, he's great. But he's like put his DNA in that business around like philosophy, and it's really important for that business to have someone with that credibility, as well as the tech person, as well as like the CEO visionary salesperson. And so I think each one is a bit different, but like it just depends. And I could see in like biotech, you'd have that same flying formation, but then you'd have someone that's like, a virologist or someone who's like, the deep subject matter expert there. But like typically those are sort of the two flying formations we go with. And then I won't ever start a company, like we'll help people find that awesome AI person because we've got a really strong network, or we'll help source a CEO to like an AI person that wants to build something. But we'll never start a company without a CEO, and we'll never start a company without a tech person, because that was we've done both before, and it was like not happy times.
Right. As you're building this, in many different directions from which competition might emerge, but really in your heart, deep in your heart, who's the real competition here, and why?
That's a great question. I'll give you two answers. So like the first is like a philosophical answer. So one of my favorite stories to tell is about Otis Elevators. Do you know why Otis Elevators is everywhere in New York?
No, go for it.
Yeah. So he invented the emergency brake on the elevator. And when he did that, he was like, great, I built something amazing. People will now adopt elevators because people are scared to be in elevators. Let me build it and they'll come. What happened is no one bought elevators still. So he went to the World Fair, stood on a wooden platform, and cut a rope in front of a bunch of press to show that his brake could stop and basically work and be safe. And that's called a trust factor. And I was like debating this with someone earlier the other day. It's like, we can all debate at how fast the tech is growing right now, which I think it's like the fastest it's ever been in my lifetime. And like, will that, if you go to AI 2027, there's a bunch of different scenarios, but like, when will we hit AGI? And can we hit AGI? That's a great debate. But there's another factor in this, which is like the human trust component. So like, no matter how fast technology moves, I think our trust moves on a different vector and a different scale. And so like, we've had the technology to have self-driving cars for a while now. We don't have self-driving cars, right? Like, we have the technology for flying cars. We don't have flying cars, right? Well, it's because we like kind of don't trust each other to like zip around in flying cars. Or like, I was in a Waymo in Austin, Texas the other week. It was a delightful experience, but then my wife took it and she got like stuck in a circular loop, and then someone had to like call in and drive the car away. And I think it's a work in progress, but there's like a trust factor to the tech. And so I think our biggest competition philosophically is that trust factor. And that's what AI services does, is it allows us to sort of hack that trust factor curve and end up just like delivering, like, you believe in AI, you want a great product like design or an EA, you can get it, right? Boom. That hacks that equation. Very tactically, I think more and more people are starting to figure out that the full stack AI is the play. So like, Y Combinator is looking for full stack AI companies right now. There's multiple like tier 1 VCs that have raised hundreds of millions to do AI kind of like roll-ups in the services space, where the thesis is like, let's go buy 100 million in XYZ business and then convert AI into them. And I think that like, they're all kind of like chasing the same thing we are, but like, we're counter positioned where like, we really believe that like, we need to create our business and then do it within our Holdco. And I think that makes us like a little bit different. Not to say like, I think at the right time I would consider roll-ups and other things, but that's my two answers. So philosophically, we compete against trust, or compete for trust. And then very practically, I think there's a lot of people doing like PE type roll-ups, as well as like YC is coming at this now.
Right. All right. Final question. 5 years from now, what does Infinity look like practically in terms of number of companies, maybe ARR? What's the Holdco headcount? And also, to achieve that, what AI advancements that are happening now are the most exciting to you?
I don't know about like the tactical stuff. Like, I would hope we have, like, with a cultural value like headcount kills, I hope we have low headcount to like employee. I like want a really high revenue to employee ratio, so I'll give that. And then for us, like, my goal is to first get us to like 20 something companies, which I think gets us to about 100 million in ARR, or about $1 billion in EV. And then it's really going to be like, what do we need for the public markets? And that's like really what I'm focused on. But I want to show that we're not just a Holdco full of assets. I want to show that we're actually like an engine for creating new AI startups and in the services space. And that, I think, will put a higher multiple on the business and be really valuable. So like, we'll also have our own tech, great companies, which we're working on now. We're going to have a lot of different businesses in different verticals. I think we're going to be able to go after more and more attractive founders and be like, hey, instead of like going raise venture, come build with us. Like, this is faster. This is better outcome for you. And that's really like how I see it. And ultimately, I think Infinity could be worth trillions in EV, because this is the first time ever in our lifetime that we're really approaching a 200-year-old service industry. Like, everything from business valuations to pool cleaners can get disrupted right now with technology. And like, I want us to be the ones to do it.
Amazing. All right. With that, we're at the rapid fire round. I'll ask a series of questions and would love to hear your answers in 15 seconds or less. You ready? All
Let's
right.
do it.
Question number one. What's your favorite book?
My favorite book?
Yeah.
0 to 1, Thiel.
All right. Next question. Which historical figure do you admire the most and why?
Probably either Alexander the Great, because I'm Greek, or Augustus Caesar, because he built Rome like really prolifically, and his biography is really, really crazy.
Yeah, I really appreciate those references because I'm a big history nerd, and I know exactly where that might come from. So that's amazing. All right, yeah. Next question. What has been an important but overlooked AI trend in the last 12 months?
I think the human trust factor. Like, we're so fixated on how fast the technology can develop and compound, but so many people I talk to are still like, they're still basing like their experience with AI off using ChatGPT from 2 years ago, being like, but it hallucinates. And I'm like, have you
Right.
like, like you can connect Anthropic to your email and just be like, who have I not emailed back in the last 4 days? And it like returns it.
Right.
Like, it's pretty incredible.
Right. Amazing. All right. What's the one thing about service-based companies that most people don't get?
I think how essential they are to our economy and our GDP. I think we really focus a lot on like Fortune 50, and as founders, you're like trying to sell into like Fortune 500 or FANG companies, and really like a lot of these businesses that are service businesses that are our neighbors' businesses make up a huge portion of GDP around the world. And I think we're in this like moment where AI can create like massive GDP expansion and enable a whole new generation of entrepreneurs. And I don't think that's like baked into any economic forecasts or anything. Like, people are focused on like job losses at like IBM or like JP Morgan or whatever. They're not like thinking like, wow, like my neighbor, like we could all create businesses that are going to be better, and like our neighborhood GDP is going to go up. And I think that that's pretty powerful.
What separates great AI products from the merely good ones?
I don't know if I know that one yet, but I really like the product experience of Claude. And I think you can tell that they're just like really like a really thoughtful product team, and they've done a lot to care about like the design and the user experience of it. And so for me, like, just because I was part of the team of Simple back in the day, they built a lot of design forward banking, and I worked with some amazing designers there. And I'm a sucker for really good design, like user design.
Yeah, I think design is becoming extremely important because the baseline has grown so much that everyone expects a product to look nice and cool and fun, and that's the baseline. So, fantastic. What have you changed your mind on recently?
That's a great question. I used to be very like, I can de-risk investments in the US and start companies only in the US. And I think there's actually like such massive blue ocean opportunities like in the Middle East and the Gulf region, South America, Europe. I think that there's a lot of AI service opportunities all around the world. And I've sort of like changed my tune on that now, where I've like flipped around with my board saying like, actually, I want to do more stuff outside the US, because in some cases, I think there could even be bigger markets unlocked. So like, I think Dubai and the Middle East and Abu Dhabi, like there's actually very big sentiment from those governments to like adopt AI in a real way. And they're very serious about it. And like, they have, massive plans and massive investment that they want to put behind it. And I think that there's like big things to be done.
Right. That's actually a good one. Because in half my life I was in India, and here I think you have a more of an appreciation of what outside US can. It's a huge market. You're right. I think it's a huge market, and I think unless you
it's always so hard to like.
Yeah.
For me as an entrepreneur in the US, like if it's in San Francisco or New York or wherever, I can like background the founder. I know the laws. I know the country. I know the investors. When you go into a new region, like I don't know all those things. So it's like, I think you have to find new ways to de-risk it. But like, there's also, in these investment equations, there's always the IRR question. So it's like the beta goes up, but the IRR can also go up quite a bit, especially if you're first mover. And like, I spent time in India. Like, I think India is going to be an amazing AI services market and AI market in general. And I think what'll be very curious is like where they start building a lot of data centers for compute, and then where there'll be like local models and local regions doing different things, because I see that whole industry getting more and more fragmented, which then will incentivize, further startup growth in all those markets.
Yeah. All right. Next question. What's your wildest AI prediction for the next 12 months?
My wildest AI prediction. I don't know. Like, honestly, they've kind of all been like hit, and I keep getting like really surprised. And I'm like, for the first time in my startup career, I keep being like I keep underestimating it, because I'm like so skeptical about tech. I'm like, well, it probably can't be like a VC fund analyst. And then my team just like busts out and they have like an AI that's like doing LP reporting. And I'm like, whoa, okay, that's legit.
Yeah.
And so it's probably like, I think the wildest take of some tech I've seen is I think that there's like now an opportunity to literally have an AI avatar on Zoom, or like I could be an AI avatar right now talking to you in a podcast. And I think like probably the next 6 to 10 months, like we'll get to a point where it'll be that and you won't even realize it. And I think that that could be very interesting for like social situations or interviewing or all sorts of things. But it also creates like some virtual identity issues. So that's some stuff I'm thinking about right now.
All right, final question. What's your number one advice to founders who are starting out today?
Founding is your biggest personal growth journey. It's not about making money. It's about growing. And if you approach it that way, you're going to end up finding what you love and just do that. And for me, it's never been about, I mean, legally, I have a fiduciary obligation to make my investors as much money as possible. But personally, it's all about like my own personal growth. And like, that's why I'm addicted to doing this, because I'm like growing and making myself better. And, I honestly like I think we have a once in a lifetime opportunity right now, so that if you're a builder and you can come and change and create, like you can help change the world's GDP with implementing AI and service businesses and like transform your country, your town, your region. And I think like those of us who can create businesses, like have the obligation to do that right now.
Amazing. Brennan, this has been a brilliant discussion and also very unique, because I think in the 175 plus episodes I've done, I think you're the first like Holdco person running an actual AI Holdco. And this is the mechanics are amazing. It's just brilliant. So thank you so much for coming onto the show and sharing your insights.
Thank you for having me.